This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
It is my pleasure to welcome Professor Campbell R. Harvey to the show. He is the author of a great new book entitled DeFi and the Future of Finance. He also has been making the rounds on the media talking about the inverted yield curve. So we're going to touch on both of those items and maybe a few more things. He's a professor at Duke University, and it's good to have him today. Campbell, welcome. How are you?
I'm doing well. Thank you for inviting me on the show.
My pleasure. So first, since it's more of a current event, let's talk a little bit about the yield curve. You know, basically for the last several decades, an inverted yield curve has predicted every recession. However, this time we're all wondering if maybe that rule is out the window, or is it still true?
Yeah. So this is my dissertation at the University of Chicago in 1986. And at the time, the yield curve, and let me explain exactly what's going on here with the yield curve inversion. Usually, a longer-term interest rate is higher than a short-term interest rate. So
when you're being paid on the interest rate as the lender, the bondholder.
So think about going to the bank, you see some certificates of deposit, and the rate is higher if you lock for 5 years than if you lock for 1 year. So that's a normal yield curve. But sometimes it goes and turns into something very unusual where you've got this situation where the short-term interest rate is actually higher than the long-term rate. Right. And that's called an inverted yield curve. So I found in 1986 that happened since the 1960s 4 times, each time a recession followed. And then after I published my dissertation, we had 4 additional inverted yield curves, and every time a recession followed. So it's 8 out of 8, and importantly, no false signals. And today, we're in a situation with an inverted yield curve. So the yield curve's been inverted for 12 months, and the usual lead time to a recession is 13. So we're pretty close.
Right.
And then some people have noticed that, well, the yield curve is kind of flattening out. But it's important to realize before the last 4 recessions that the inverted yield curve disappeared and became normal before the recession started. So we're right in the range right now. We're going to see it's a little confusing because the economic growth seems very strong, but 4.9%, that's really strong.
That's very strong. Yeah.
Yeah. You need to remember where that's coming from. And that is coming from exclusively robust consumption spending as consumers wind down some of these excess savings that occurred during COVID. Right. Those savings have run out, and we can see it looking at the savings data, and we can see it looking at leading indicators like credit card and auto loan delinquencies.
Balances are going up, yeah.
So 2024, I think we're on track. We'll see what happens. Hopefully, the slowdown is mild. Nobody wants a recession.
Before we get into that, I just want to ask you a couple questions about some things you already mentioned. First of all, it always bugs me that the various charts I see and the articles that I read about consumer spending, consumer debt levels, credit card debt levels, auto loan debt levels, whatever it is, they never say if they're adjusted for inflation. And that drives me absolutely batty. So are they mostly or not? You know, when they say, well, we've got the highest debt level ever, $1 trillion or whatever it is, right? I don't know if that's adjusted or not.
So usually it isn't adjusted, but we adjust it in a different way. So think of looking at the national debt. If we divide that by GDP, then the inflation essentially cancels out, and you get a percentage of GDP that the debt actually represents. And the national debt is staggering. It's like $33 trillion. Our GDP is 27. If you take out the federal agency holding of debt, it's somewhat less, but we're in around 100% of GDP. So when you look at it in terms of percent of GDP, you get rid of the inflation component. And you make an excellent point on that people just look at the level. It's not the level because of inflation. You need to look at this in terms of the proportion. The other thing that's important to look at is the debt service. So how much interest we have to pay.
Right.
And right now, that's very close to $700 billion. And again, I'm taking out the interagency payments, $700 billion. And it will be, and this is $700 billion with an average interest rate on that debt of 2.8%.
Mm-hmm.
And we know rates are over 5 at the short end, right. 4.5 at the long end. So we know that's going to go up. So in 2024, the debt service, so the interest that the government has to pay, the treasurer pays on the debt, will become the second largest spending category behind Social Security. So bigger than Medicare, bigger than defense.
Right.
So I think people should be nervous about that. That's not a good situation.
However, that makes me have a lot of faith that a Fed pivot is coming, because won't there be a lot of pressure from the government on the Fed to say, hey, we've got to see some lower rates because the cost of servicing our debt is just getting too high? Wouldn't that sort of bode well for an interest rate cut?
You would think that the Fed might take that into account. There is a separation between the Treasury and the Fed.
Right.
So indeed, in the public debt, the debt held by the public, that includes the debt that the Fed holds because it's not considered part of the government.
Right.
So it is the public. Now, nevertheless, that said, the Treasury Secretary is a former Fed chairperson, and you would think they would want to take this into account, because if these rates start to continue to go up, this is going to put a lot of pressure.
It's going to put a lot of pressure on regular banks, too, not just the Federal Reserve. Yeah.
Additional borrowing to pay the interest.
Yeah.
Like that is a bad idea.
Some call that a Ponzi scheme. It's a different flavor.
We've seen how this plays out internationally.
Yeah. Right.
When you have to start to print money to pay off the interest on your debt. No, that's something to be avoided. And I do think that this should get more attention.
Right.
So I think that most people don't realize that next year, just the interest cost of the debt, forget the refinancing, just the interest cost is more than defense and Medicare.
Right. So does that bode for more inflation then?
Well, do you think the
future is inflationary?
So the risk is that we need to essentially create money to pay for the interest and the refinancing and things like that.
Yep.
And when you create money like that, it will be inflationary.
Yeah.
So we know that's the case. So I do think that inflation will be higher in the medium term than the market is expecting. And there's actually a number of reasons for this. One reason we've already talked about, that there's enormous pressure just to service the debt, and the temptation to monetize that is very high. The second reason is that we have underinvested in climate, and that will just be a reality that we have to make large investments to put our world on the right footing.
So more expenditures, more inflation.
More expenditure. And then the third thing is reshoring. So this is the idea of deglobalization.
That's more expensive than offshoring.
Yeah, it's cheaper to produce something in China, but if they actually cut us off, that creates a lot of risk. So I think our policymakers have realized that they need to reshore or to deglobalize just as a matter of risk management, and that's expensive. So you put these three things together, inflation will be higher than the 2%, which is the Fed target.
All right. Okay, so I want to go back to the yield curve before we get into decentralized finance or DeFi, because you are really the seminal expert on the yield curve. So what I didn't get to have you explain to the listeners before is, number one, why does the yield curve invert? And why is that a predictor of recession?
Yeah, so the original thesis was that this inverted yield curve was capturing expectations about economic growth in a very, very interesting way. We know that assets like stocks are just the value of the expected cash flows in the future. And for stocks, earnings depend upon the strength of the economy. So it makes sense that there's some information in the stock price today about the future in terms of economic growth. And bonds are even cleaner because with bonds, you have a coupon, you know exactly what it is, you know the maturity of the bond, whereas you don't know what the dividend is, you don't know the maturity of the stock and things like that. And also bonds are fairly risk-free. So the idea in economics that the bond interest rate has information about expected inflation, expected real rates, so rate minus the inflation component, and there's also a risk premium, which is kind of small for government bonds. That real interest rate is really crucial for economic growth. Mm-hmm. So it nicely ties into economic theory. Like another way you can look at it, and all inversions are different, but often it's the case. And an example might be global financial crisis, that when people get nervous about the economy, they flee into what is perceived as the safest possible asset in the world, which is the U.S. 10-year. Yep. So it bids the price up, the yield goes down, and we get an inversion.
Right.
So again, it's a flight to safety. It's well grounded in basic economics, and it works.
Sure. So this is a barometer of the flight to safety. And that flight to safety is saying that people are fearful, so they're going to go for the treasuries.
Yeah. So in general, that's correct. This is subtle, but I believe that there's a big difference between today and when I published my dissertation. And that is that people notice the indicator. Mm-hmm. So just the fact that the yield curve's inverted, that changes behavior. So a company is not going to bet the firm on a new investment in an environment with an inverted yield curve. Yeah. So the yield curve now is a causal mechanism. So it actually, when you don't make that big investment, it slows the economy just naturally.
Yeah, right.
So
it becomes what S.I. Hayakawa, when he talked about self-fulfilling prophecy, something that is neither true nor false, but is capable of becoming true if it is believed, right? And so it becomes a self-fulfilling prophecy, and there you're in the vicious circle, right?
Yeah, that is exactly the terminology, self-fulfilling prophecy. So that it is causal on that dimension. It also wreaks havoc on our financial institutions. So you think about banks, they pay out a deposit rate, which is a short-term rate, and then they invest in loans and government bonds and stuff like that with a longer rate. So that's what they receive, the longer term, and they pay the shorter term. So when you invert the yield curve, it immediately provides stress on our banking system. Right. And we're seeing that today.
Yeah. Good points. Okay, let's switch gears and talk about an exciting newer development that is, happening in the financial world, and that is DeFi, or decentralized finance. When most people think of that, they just think of cryptocurrencies. Is it only that, or is it more than that? Okay, so go ahead and tell us.
Yeah, it's a lot deeper. I've taught this material for the past 10 years. Mm-hmm. So I've got a long track record in this space. Indeed, my first business idea in this space was almost 25 years ago. So the essential issue here is identifying problems with our current financial system. And this is not about, FTX or Sam Bankman-Fried or the fluctuations in the price of Bitcoin. This is about identifying problems and coming up with solutions that are credible. So, for example, today we are dependent upon the SWIFT system for wire transfers and stuff like that. What if it goes down? Mm-hmm. And it's actually fairly easy to disrupt. Yep. What if it goes down? Then there's no alternative right now. And that's pretty unacceptable.
Right. Well, Russia has an alternative now, and so do the BRICS.
But it works within Russia and maybe a few countries. That's it. So we need a different global system. And DeFi provides a way to do that. But
Right.
more
So
importantly,
XRP or Ripple, that's one of the big DeFi crypto solutions. Is that the
so
solution?
Ripple's business model is to provide an alternative to Swift.
Right.
And they've done a fairly good job at that, but it's not the only one. So within decentralized finance, there's many different possibilities here. So we have been dependent upon our commercial banks, our central banks, and then like a monopoly power within your own fiat currency. In this new world, you've got many different ways to store value and to use value in transactions. And just like a few examples here that don't make any sense to me, that a wire transfer could take 2 to 5 days. In this new world, 15 seconds. And the security is unprecedented in terms of this new situation. Another example, I buy a stock, but the stock isn't in my name yet. It takes 2 days to settle into my name. So that, again, seems unacceptable. And within this new space, the settlement and execution of trade are simultaneously happening. So there's a lot of stuff here. This is about financial inclusion. And there was this very interesting article in, I think, the New York Times this weekend about people being debanked. So just getting a notice that, we're closing your account.
Right.
There are 1.7 billion people in the world that are unbanked. With this technology, you just need a smartphone. And the smartphone is your bank.
But when you say this technology, do you mean Ripple XRP?
No, I mean decentralized finance in general.
Right,
so
but
Ripple
how...
is one particular idea within this space. So there's many possibilities here. It's not just one thing. So there's many initiatives happening at the same time.
Good. What I'm saying, though, is let's just be kind of pragmatic for a minute more than conceptual. If someone listening to this likes everything you say, and I certainly like everything you say, what do they do? Because with Ripple XRP, you basically have to invest in a coin that is not very stable. And that's the problem with it. It's not really a system per se like Swift is. Well, I guess on Swift you can only transfer dollars, so you could probably make the same argument. I don't know how to come to terms with that,
So most of Ripple's business model has to do with large institutions transferring money. And it is true that their XRP token is volatile, but it's not volatile over a 2-second interval. It's only if you hold it for a longer period of time. So it's just used as a conduit. So you switch into it and you transfer, you switch out of it. So that risk is greatly mitigated. But there are other technologies where if you want to do fiat, you could use a stable coin like USDC based in the US. And it is guaranteed to be exchanged at par. So you don't need to bear that volatility. But this technology, again, it's early. What I'd like to write about is stuff that will happen in the future. This is not ready to roll out. It'll be ready for widespread use when it's so easy that you go to your grocery, usually tap with your phone, and there'd just be one extra thing. You decide what you're going to pay in. So you could pay in US dollars. You could pay with a token that's backed by gold, have a token that's backed by Apple stock. So you just choose what to pay in. And it's got to be very easy. We're not there yet, but the foundation is being drawn up. And this is really important, that while people are focusing on the price fluctuations of Bitcoin or Dogecoin or stuff like that, there is a lot happening in a very exciting space called Web3. So Web3 is Web2, which we have today, with decentralized finance backbone. And let me give you an example of a Web3 application. So think about your computer. How much of the CPU do you actually use in a day?
Right.
Like maybe an hour?
Yep.
So what about renting out overnight at minimum?
Right.
And you get paid in real time.
It's like SETI. the search for extraterrestrial life. A
Except you
lot of
get
people
paid.
volunteered the processing power of their computers, but this way you get paid for it. So it's sort of like the sharing economy. I mean, look at our cars that sit unused 96% of the day, right?
And it's the same idea. Same idea. And you get paid, and you get paid in a token. And you might say, well, how does that token have value? Well, it definitely has value because the people that need the computing power, they need to buy that token.
Yeah.
So you have both sides of the market. And then you might say, well, who knows what it's worth? So, well, actually, it's pretty easy to value. You just look at a comparable like Amazon or Microsoft. What are they charging for computing? So you can use decentralized finance in this way, whether it's computing, whether it's storage of data, whether it's ride sharing. Ride sharing is just an algorithm, right? So there are so many applications that affect the very largest businesses today. I give you one more example. Google and Facebook and Meta, these companies are in the business of selling your data. So if I view an ad, then they get paid, but it should be that I get paid.
I couldn't agree more.
And again, Web3 allows this. So if I take the time to view an ad, I get paid. And I get paid in a token, and I can dump the token for US dollars immediately. And I know there's a market for it because the advertisers need to buy that token.
Right.
So this is a very powerful idea. It's under the radar largely, while people focus on the Sam Bankman-Fried trial and all this stuff. There are hundreds, if not thousands, of companies, exciting ideas happening in this space that are focused on kind of traditional businesses.
And some of the stuff you've described is, what Ethereum is meant to solve too. I mean, you're saying it's not here yet though, right? None of this stuff is really ready for prime time, is it?
So it depends. So for certain applications, it is, but it's just not user-friendly enough yet. So it takes some time to set up, for example, a wallet on your smartphone, and most people just don't have that widespread kind of adoption yet. This is an idea for the next 3 to 5 years.
Sure. And for the early adopters listening or watching this, though, what should they use? I mean, should they be just using Ethereum and Bitcoin and Ripple and XRP today, or
So decentralized finance is really focused on Ethereum. So Ethereum allows us to run small computer programs within its ledger, which is very, very effective for a lot of these applications. So
but it has high gas fees. I mean, to move the value around, I guess you pay for what they call gas, right?
So, and for your listeners and viewers, if I run a computer program on Amazon Web Services, I need to pay a fee for that. And that's what this idea of gas is. If I run a program on the Ethereum blockchain, I need to pay. And you make a good point that the fee is pretty high right now, but the keywords are right now. So there's many initiatives that will reduce that fee in the future. So we will have the ability to do all these micro transactions. There'll be no monthly bills, right? So for example, if you're watching a video, you pay for what you watch. You watch 10 minutes of it, fine. That's it. There's no monthly bill or fixed bill for a movie or anything like that. Everything is pay as you go. And whether it's a cell phone or music streaming, video streaming, that's Web3, and DeFi makes that possible.
Yeah. It's really a fascinating time, no question about it. But the $1 million question is this, maybe. I'm a big fan of the idea behind DeFi, the freedom and the libertarian ideals behind cryptocurrencies and so forth. However, as I always say, the two most powerful forces in human history are governments and central banks. They have standing armies. Right. And the number one product, if you will, of any government is their currency. And that currency product, these things compete with the dollar, the yen, the euro, the Brazilian real, the rupee. These are competitors to their currencies, right? They want to promote their currencies. If people don't use them, if people use them less, that weakens the value of their fiat currencies. So do you think they're going to stand by and let this revolution happen?
I don't think they have any choice. The horse has left the barn already. Yeah. So the CBDC is kind of reaction to all this, the central bank digital currency. Right. So there's just no good reason to have a monopoly over a payment mechanism. The US dollar, the euro, they'll remain in the future. And we'll have to pay our taxes in US dollars. Government employees will be paid in US dollars, but people will have a choice. Yeah. And this is not about being a libertarian or anything like that. This is about just having a choice. Mm-hmm. And this is about financial democracy. Everything in this space, there's no kind of client, customer, institutional investor, retail investor. Everybody's a peer. Well, it doesn't matter who you are.
That's great. I can't imagine anybody objecting to this except the big financial players. I would imagine Goldman Sachs doesn't like it. Okay. JP Morgan, I know they're playing in this a little bit, and I know Jamie Dimon's prior remarks and how he changed his mind, et cetera. But, largely their business, just like the government's business, if you will, depends on dollars, fiat currencies.
Yes. They have been disrupted. And those that are forward thinking, like JP Morgan, see a path where they can be a winner in the future if they're aggressive today. Indeed, the CEO of BlackRock has made the statement that he sees a very exciting development. The next big thing is to tokenize all stocks and bonds and financial assets. Yeah. So this is a person forward looking and realizes that BlackRock can be a winner in this space. Those that resist and don't invest in a new technology like this will be losers. They'll be left behind in the dust of history. So
I would imagine the government putting a lot of pressure on those big financial players, though, to not do that. Yeah, maybe they're doing it as a way to be seen as pacifying people that are interested in it, or just, greed, and they look at it as some extra business. But I can't imagine the next time the next round of bailouts is needed, right? I can't imagine the government giving money to a company that is supporting a currency that's competing with their currency. That's hard for me to fathom.
In this space, everything is transparent. Yeah. And there's no bailout. So this is a totally different space.
Right.
So we've got
let's assume that they're still in their current businesses. And they have a Bitcoin fund or an Ethereum fund on the side. Listen, I want to just tell you, I want to make it clear. I want to be wrong about this. I'm just playing devil's advocate. I hope everything you say comes true because I love it. I'm a huge fan.
There's other important issues. And one is that this is not a national idea. So these blockchains or these ledgers exist on thousands of computers around the world. Right. So you can ban crypto like China did, but that shuts their economy out of everything that's based on Web3. Mm-hmm. Web3 is a big deal. Yeah. And to close off an economy to a major innovation like this means you're going to have lower growth in the future. And we're already seeing that. They've made some very poor choices, not the only one, but they have given up the growth vector that they've had. So I do think that what we need for the US economy especially is growth. That's the only way that we can pay down some of these debts. So we need to be open to these financial innovations. My own academic research shows that when you reduce financial frictions, so you take out middle people, make things
more velocity,
more affordable, stuff like that, that leads directly to economic growth, and we need economic growth.
I couldn't agree more. Hey, last thing, and I hope everything you say comes true. Just wanted to ask you about, since you are so into this, any comments on El Salvador and, Bitcoin Beach and the way they tried to get the country onto Bitcoin and it didn't really work, but, it was a nice try and very symbolic.
I'm all for experimentation, but as I said earlier, we're not quite ready to launch at that scale. So I do think that if you look at the rate of adoption of these technologies, that emerging markets will be the leader. Because in many of these emerging markets, the central banks cannot be trusted.
Right.
And the government's fiscal policy sometimes is irresponsible. So you need an alternative. The example I like to give is Venezuela, which is in a hyperinflation, irresponsible central bank and government. It used to be if you're rich in Venezuela, you were hedged because you had a US dollar bank account in Miami. But now the average person can have on their smartphone some USDC, which is a stable coin tied to the US dollar. So effectively, if you've got a smartphone, you've got a bank in the US, and then you can hedge against the country. So I do think emerging markets will be a leader in this space, but there's a lot of exciting developments, and it goes well beyond the sort of mainstream media coverage of this. And I do appreciate you diving deeply into it.
Yeah. Thank you. And thank you for joining us, Professor. Give out your website. And of course, your books are available in all the usual spots with great reviews. But do you have a website or social handle?
Yeah, just search my name, Campbell Harvey. You'll see links to it.
Good stuff. Well, Professor Campbell Harvey, thanks for joining us.
Thank you.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.